Ladies and gentlemen, welcome to another Independent View with your host, Lobo Tigre. Our guest of the day is Lyn Alden, founder of LynAlden.com or Lyn Alden Investment. We've had Lyn on before, one of the most popular video interviews that I've done, so thanks, Lyn, for that and bringing all the attention you do to important matters. We're talking now the day after Fed Day, all kinds of things rocking our world. We've got a lot of questions for you. But before we go there, I just wanted to offer the audience a bit of a disclosure. LynAlden.com has become an affiliate of IndependentSpeculator.com. So no arm twisting here, but if you like my work and if you like Lyn's work and you want to support her, one way to do both would be to sign up through the links on Lyn's website, and then she gets credit for any sales. So if you're a Lyn Alden fan, this is one way to pitch in there. Lyn, I don't know if you want to comment on that before we dig in.
Yeah, absolutely. So I get a lot of questions about, I cover commodities pretty regularly. It's one of the big themes that I cover, often bullishly, sometimes bearishly, but I don't go into individual small companies. And so I occasionally get recommendations. I occasionally get questions for recommendations. And the problem is that in this industry, there's a lot of hype out there. A
You've
lot
noticed
of,
that.
yeah, a lot of hype. It's not an industry known for, I guess, quality in general, even though there are gems out there. And so when I came across your research and talked to you, I basically felt comfortable recommending that one for people because there's a clear track record. I was able to check out the research and see that it was not spammy, not hypey, and that it basically covered things very meticulously. And so I basically wanted to make sure that people had that resource, known to them if they want to go down into those smaller companies that I just can't cover. I don't have the bandwidth for it. I don't really have the expertise or background for it.
I appreciate that. And, kudos for knowing your limits. And sort of on the flip side, it becomes sort of a go-to for me. If you write something on some macro topic, I want to read it because, I don't know, maybe I'm so in the weeds of looking at these individual mining companies and all these thousands of juniors. It really helps me when you put the macro context in place for us. So win-win, I think. It's a good fit here, and I'm happy to have you back on the show. So, macro overview. We hear you, we see you online. I think most of the audience is generally familiar with your views, but here we are the day after Fed Day and the great hawkish pivot of the Fed. What do you make of that, and does it change your outlook any?
Yeah, so it's basically in line with what I wrote about in my recent research piece, essentially that they are getting tighter in rate of change terms. They're still very, very loose in absolute terms, right? So if you look at the Taylor rule, which takes into account GDP growth and inflation, it points to the fact that the Fed funds rate should be at 7.5%, whereas right now it's 0%, and they're still buying assets. And so even the projections they have for rate hikes, next year and the year after, are still well short of that rule. They're basically still deeply negative real rates. And so we've seen this kind of trend all year where emerging markets are the most, they have the least kind of flexibility in terms of managing their currencies. And so a number of them have been hiking rates all year. They started early in 2021, or some cases mid 2021, and many of them have been hiking rates. Obviously, you have some exceptions like Turkey that are kind of on their own, whatever they're doing.
Yeah.
But you have other ones like Brazil and Russia and other countries that they basically saw that the developed markets were going to start tightening, and they had to get ahead of that because they have dollar-based debts. And so if they have a big differential between their currency weakens relative to the dollar, that's a problem for them. So they had to shore up their currencies in some ways ahead of time, and now we're seeing it out of the developed world banks. So Canada and Australia started getting a little tighter. Bank of England's getting tighter,
Yeah,
and the
just this
Fed,
morning.
ECB.
Sorry, just this morning the UK, a tiny little hike, but still.
Yeah, it's and it surprised people. So we are starting to see tightening. So my base case is we're going to see tightening for a period of time, but it's tightening that from a position of being deliberately behind the curve. So basically, it's still way below the tightness you'd expect in most circumstances, and that's because of how much debt is in the system. So this has been a big macro theme of mine for the past couple of years, that we're in what I would call, or what others have called, their long-term debt cycle, or debt super cycle, whatever you want to refer it to, that essentially is not a normal business cycle because they've driven rates all the way to zero. They've gotten debt as a percentage of GDP so incredibly high, especially in the sovereign level now, which was not the case in prior cycles, that they can't really afford positive real rates anymore. So they're kind of stuck in this financial repression scenario where they hold rates below the inflation level. And so they're kind of stuck between a rock and a hard place. On one hand, they want to fight inflation. On the other hand, the inflation's caused by fiscal spending rather than bank lending. So if you want to we can go into that difference. But then in addition to how much debt there is, they just don't have a lot of tools on the table in order to deal with it. So you see power prices spiking in Europe, and they're still holding rates at zero, still doing quantitative easing. Or in their case, some of the rates are negative. And so basically around the developed world, they're more trapped. Whereas in the emerging world, you have a whole other set of problems, but they still do have rate flexibility because they generally have less sovereign debt as a percentage of GDP, but they're in the precarious position of having some of their debts denominated in a currency that they don't control.
Right. Let's zoom in on that for a bit. Particularly, I know that the world is larger than the U.S., but commodities, gold and silver in particular, near and dear to my heart, priced in dollars. So let's look at the Fed aspect of this for a moment and dive in there. I am partial to or persuaded by the theory that they really can't let rates go too high. If rates were to actually go Volcker on us and trounce inflation, the national debt and the payments become totally unmanageable. I get that. The math seems pretty compelling to me. Is there a red line there for you? I mean, obviously they can let it go up. 0.25 isn't really going to kill anything. At what point does it become dangerous, or how much wiggle room do you think the powers that be have here on this?
So it's a great question because I see on Twitter and elsewhere people saying that, debt's so high the Fed can never raise rates ever.
Yes,
And
that's exactly the point. Sorry, I got to jump in. It drives me crazy. These people on Twitter or other social media, they make these absolute categorical statements like, I know for a fact that the Fed can or can't do or will or won't do this. It drives me nuts. So that's why I'm asking you, give us a rational Lyn Alden, guidance here for what can or what might be the case here, if you can.
So essentially the general theme in my view is that they're going to hold rates at a negative real level, but they potentially can get off zero. Now, if you work out the math, if you have $30 trillion in debt, then for every 1%, you're talking about $300 billion in annual interest payments on the weighted average, uh, you know, uh, you know, interest rate for the government debt. So just because they raise interest rates doesn't mean that all debt goes up by a certain amount because they have a range of different maturities. But if you basically raise rates and hold them there for a period of time, a lot of that debt starts refinancing at those higher rates. And a very large portion of the U.S. federal debt is the T-bills, right? So very, very, very short duration that refinances quickly. And so if you were to get the 3% or a little over 3%, let's call it, and hold there for a while, you would eventually approach $1 trillion in annual interest payments alone, which is a very large percentage of government tax receipts. And so I view once they start to getting above 2-3%, that starts to become kind of a red line in the sand, assuming that they hold that for a long period of time. Nothing prevents them from getting there momentarily. There are other things to watch that could break prior to that, right? I mean, if they were to strengthen that, if they were to tighten enough that the dollar strengthens, then you can start to get kind of a March 2020 scenario where the dollar spikes, and then it causes the foreign sector to sell some treasuries in order to get dollars because they have dollar-based liabilities, but many of them have dollar-based assets that in many cases exceed their liabilities. And so if you look at the BIS, for example, they estimate there's about $13 trillion in U.S. dollar-denominated debt outstanding in the world outside of the U.S., but also they own over $40 trillion in assets. And there's not necessarily like an overlap. So, for example, a country like Turkey has liabilities, but doesn't really have the assets that cover it. Whereas a country like Taiwan has far more assets than they have liabilities in those currencies. Same thing with a country like Saudi Arabia. And so some have more flexibility than others. But essentially, if you get that dollar tightness, you can get kind of a forced seller treasury selling, and then that can cause the treasury market to go liquid and force the Fed to buy some of them. So they could do basically a dovish pivot if they have a problem in that market. They've already cited concerns with liquidity. Now they've kind of front run that a bit because they put in a standing repo facility, so you can get kind of shadow QE without calling it QE. It's kind of what you had in September of 2019 before they had to switch to actual QE. And so I think the things to watch are to see, they have two mandates. They have employment, and then they have price stability, as they define it as, targeting about 2% inflation for the way they measure it. Now, their third mandate under the surface that actually is even more important of those is financial stability. And a lot of people assume that means the equity market, right? If the equity market goes down, that they have to act, but that's not necessarily their pain point, right? If the market grinds down 10, 20%, or over a period of time, that doesn't really force them to act. There's things under the hood, mostly in the credit markets or their plumbing, that would make them act. And so, for example, in Q4 of 2018, there was no junk bonds issued for 6 weeks. So everyone looked at the 20% S&P 500 correction, bigger than that for some of the growth stocks. We had that famous Powell pivot, but it wasn't really the equity market most likely that made him pivot. It was the fact that the junk bond market froze. That's a much more acute problem in terms of financial stability than equities going down 20%. And then you had the repo spike of September 2019 that forced them to go from quantitative tightening to quantitative easing, and they didn't want to call it that, but that's essentially what they were doing. And then in March 2020, when you had the COVID lockdown crash, like I mentioned, you had the treasury market go illiquid because you had the dollar spike because trade dried up and you had all these issues play out. And so the Fed had to come in and buy $1 trillion worth of treasuries in 3 weeks and do, launch an alphabet soup of programs. And so those are their more acute kind of touch points. And so if you hit some of those, you could see a Fed reversal. And if you don't hit those, and if you manage to grind this out longer, then I would start looking at 3% or above starts to run into kind of a red line for how they can hold rates for any kind of meaningful period of time.
All right, well, but even before we get there, sort of setting the debt problem aside for a moment, just looking at the economy, do you think we can even get that close? I mean, I can see the math that you're saying, but I have to think that if they start raising rates, the way the economy looks to me, still pretty shaky. You still have, blame it on the supply chains if you want, but there's still a lot of instability. There's still a lot of unknowns. There's still actually longer term effects of all these lockdowns. That's unprecedented. We are in uncharted waters. We don't know how long it will take to stabilize. Do you think that the economy can take higher interest rates well before we get to the debt red line?
So generally, no. I think most likely to run into one of those other issues popping up. So you could get, credit markets, junk markets freaking out. You also could get a yield curve inversion, which can slow down bank lending, which is already slow. We're not getting a lot of bank lending. And the bond market's already basically telling the Fed that they're not going to be able to raise rates as much as they think, the long end of the curve. Now, I don't trust the bond market in a lot of things in this kind of, post global financial crisis regime. When central banks are the biggest buyers of treasuries, the whole signal for what treasuries can tell us is distorted. So, for example, a 5-year treasury that you bought in 2020 was super low yielding, and it already got outpaced by inflation within a year, like all 5 years of coupons. The same thing for 10-year treasury. If you bought a 10-year treasury in mid 2020, you're already like inflation could be zero for the next like 8.5 years, and the first year and a half already erased all of your coupons. And so I don't really view the bond market as a useful tool for telling us what inflation is going to be, but it can be a useful tool for kind of sensing the rate of change of the economy. So you get these it goes up and down, I think, at appropriate times, more or less. It's still kind of that sensor. And so the bond market's kind of, flattening and saying that they are doubting that the Fed's going to be able to raise rates as much as they said. And generally the long-term track record is that every cycle they get to a lower high in terms of what they're able to raise rates to. So my base case would be to see that happen again. Now, there could be some exceptions. If you have ongoing fiscal stimulus that can kind of keep the economy propped up, and you had enough foreign demand for those treasuries such that the Fed didn't have to really buy a lot of them for a period of time, you could get a multi-year, I think, tightening cycle. So there are scenarios I can envision to get higher, but it wouldn't be my base case.
Or what if they go to shrinking the balance sheet rather than raising rates more? To avoid raising the rates to try. I mean, I'm not sure that would really help anymore. It's still going to be bad news for the economy, but maybe that's an alternative.
Yeah, it's an option. So again, it's challenging for them because there's so much debt, and the fiscal deficits, even without stimulus, active stimulus, are still large. And so it really comes down to whether or not the foreign sector is willing to buy treasuries. They've really slowed down their purchases starting around 2013, 2014. Especially China, but also other countries as well. And so to the extent that the foreign sector is not necessarily willing to finance a lot of this. And if we look at, so they just, they're in the process of raising the debt ceiling. The Fed's the Treasury's account at the Fed, which is basically their cash buffer, is super low. So they want to increase their cash buffer while also issuing bonds for ongoing government purposes. So they actually want to issue like $1.5 trillion worth of treasuries in the next 2 quarters. And so the longer that goes, if the Fed were to try to, not only stop buying treasuries, but actually start reducing their balance sheet, that starts squeezing things. Basically, the banks have to buy more treasuries, and the foreign sector has to buy more treasuries. And so you could get like illiquidity problems in the treasury market. You also can crowd out other types of investments, and so that's when you can see kind of a correction in the stock market. So I think that would run into a pain point as well. Now they could tighten for a period of time in that way, like they did prior. But I think maybe you get a year in, maybe not even that much. It's hard to say exactly how far they could get, but I think they'd eventually run into a pain point, and something somewhere breaks, and then they have to do a dovish pivot again.
All right. Well, before we move on to specific commodities and things that I know the audience wants to hear about, let's take the macro here, even more macro, to the bigger picture. I get I get it that with the supply chain shocks and the world is kind of saying, well, hey, maybe we should pull back a bit from the globalization. We should have a little more, if only resource independence or manufacturing independence. I get that people are thinking that way, but it's easier said than done. These things take time to build or rebuild. And even so, I mean, it's really hard for a U.S. factory to compete with a Chinese one, even if there are tariffs or other things. So I'm wondering how you see, or rather, really, there's a lot we could talk about on that, but specifically, there's a sense of, oh, the U.S. is booming, and the rest of the world, we don't know. Maybe China's in trouble, maybe the EU's in more trouble. But we still have a global economy, despite this, new idea of, oh, we need more independence. It's still a global economy. Can the U.S. thrive on its own? The central banks can make different decisions, but the U.S. economy is still part of a global economy. And how do you see, the world macro picture going forward let's just keep it to this next investment year?
Well, the U.S. is very reliant on foreign manufacturing of goods, and so we've been running a structural trade deficit. Really going back all the way to the founding of the petrodollar system in the 70s, but especially since the second half of the 90s with NAFTA and then China entering the World Trade Organization. We have a structural trade deficit, and so we're very, very reliant on foreign companies selling us our goods. And then also, if you look at the S&P 500, a very large percentage of their revenue is international. Now it's been kind of flat to down over the past decade. We kind of hit a peak level for how much revenue is coming from abroad in the S&P 500. It's partly because the foreign sector has been rather slow, right? It's not been a lot of growth there, and so they can only account for so much. But if you were to just subtract the rest of the world from the equation, you're taking out like half of S&P 500 revenue, right? So that's irrecoverable. And so it's clearly a global system. In addition, the United States is reliant on foreign capital flows. So because we've outsourced our industrial base so much, we're very, very reliant on financialization. We're very reliant on our asset prices going up, more so than most other countries. And so some countries have their specifically that they need their housing market to be propped up, whereas the United States is really about the equity market. Essentially what we've engineered over the past several decades is that the United States run these really big trade deficits, and then foreign countries take those dollars and then they reinvest them back into U.S. capital assets. So it used to be that they would buy our treasuries, and that kind of slowed down over time. Now they buy our stocks, they buy our real estate, they buy our wholly owned companies, they buy land. So we're essentially selling our hard assets, our productive assets, in order to keep buying, foreign consumable goods. So we're trading appreciating assets for depreciating assets, essentially. And so the foreign sector is owning a larger and larger percentage of U.S. assets. In addition, you have rising populism, right? Because we've kind of thrown our blue-collar workers under the bus more so than the rest of the developed world. I mean, in some sense, you've had a shift from developed markets to emerging markets in terms of manufacturing, but most of the other developed countries, like say Germany or Japan, have kept a lot of their precision manufacturing, and you outsource things like textiles and things like that. Whereas the United States has outsourced a larger percentage of what we used to make. And so in many ways, we're now more reliant on the global economy than many other countries. Now, in terms of trade as a percentage of GDP, the United States is less than average in that sense. So we're a little bit more self-contained, I guess, because of the size of the economy, the diversity of the economy. We have advantages there. We have really good geography as well. But no country, including the United States, is fully decoupled from the rest of the world. And so basically, if China catches a cold, the United States sneezes. If the United States catches a cold, Europe sneezes. It's this whole kind of intertwined system where it's hard to flourish over the long run if other parts are sagging.
Right. So let's. I'm not sure it's true, but let's postulate that the United States economy really is in recovery. Like we are recovering from the whole COVID smash down. But let's say the rest of the world isn't. How much does that limit growth in the U.S. or can it stall it?
Oh, it certainly can stall it. Basically, it would affect a couple things. One, it would kind of limit the foreign sector's ability to keep buying treasuries. That's a big one. Two, it just means that if you look at S&P 500, their foreign revenue would stagnate, right? And a lot of the things that they're selling to. And in addition, it could hurt the U.S. shale sector, right? So if you were to have a downtrend in oil, the shale sector is one of the more vulnerable places for that. And so it's one of those things where you could grind higher at a slower pace if the rest of the world's having an issue, but it's really hard to keep flourishing. Now, if you look at certain periods, like if you do a lot of fiscal stimulus, you can have a period of time where you decouple, right? So if you just expand your money supply dramatically, if you give everyone checks and tax cuts and things like that, and basically have this demand boom, you can temporarily decouple. Nothing prevents you from decoupling from a year, 18 months maybe, but over the long arc of time, as those things settle down, it's very, very hard to decouple, persistently.
All right. I got several different directions I want to go here, but all right, let me do the stagflation, recession question. Last time we spoke, you thought, or as I recall, there was some risk of more negative shocks putting the U.S. economy, at least, into a near-term recession. Do you still see that, or, my view is more stagflationary. There are these costs and weights on the economy, but we certainly have the inflation, and maybe it's not, classic stagflation. I mean, we don't have actual recession. But what's your outlook here? Recession, stagflation, or a reflationary boom? Can the powers that be, light off the next rocket here?
So it partially depends on timing. So one thing I've been covering is the second half of this year, 2021, we had a deceleration of growth compared to the first half. And especially in quarter three, that's where we had kind of a significant slowdown. Actually, GDP didn't really grow almost at all in real terms during that quarter. And so that was kind of a very stagflationary quarter. And there's different ways to define So if you have an extreme stagflation scenario, it means you actually have a recession with high inflation. You can also get stagflation in rate of change terms, where you just have basically the economy growth is slowing. It's still positive, but it's growing at a slower pace while inflation's ramping up. And that's essentially what we saw in quarter three. You had kind of that mild stagflationary scenario. Quarter four and into 2021, you've seen a little bit of a growth deceleration for a period of time. There's all sorts of again, going back to the foreign sector, you have different countries locking down at different times. You have different virus variants, whatever the case may be. You have these different kind of ebbs and flows, and so we've had somewhat of a receleration. So I wouldn't describe that fourth quarter was stagflationary. I think as you look into 2022, if they continue on their tightening path and there's less accommodation, I think inflation is still going to be pretty hot for a while. And so you can get that stagflation, at least in rate of change terms. You might not have an actual recession, but I think it could be less, pleasant than it was for many people in 2020, 2021, where you were just getting money and you could go like speculate on stocks with it. Depending on where you were in kind of the economy, it was pretty easy for a lot of people. Where I think 2022 is probably going to get harder. One caveat that I'm watching is to see if we get one more stimulus before midterms, right? Because obviously the political calculus changes most likely at the midterms, and currently politicians are working on the Build Back Better bill, and that has stimulatory aspects to it, so it has ramifications for nominal GDP and deficits and inflation, things like that. Now, a lot of it is kind of somewhat slower acting than say some of the stimulus check bills, but there is still the child tax cut credit that would be extended, and that's still rather fast acting type of stimulus. That basically is a more direct capital injection, and so the passage or not passage of aspects of that bill could, affect the timing of things over the next, call it, 12 months.
I've thought about that, and clearly, there are votes to be bought. So another stimmy check would be one way to do that. But if the economy is supposedly recovering, I mean, we just had Powell tell us how great the economy is doing, that they can even think about raising interest rates. How do you go with a straight face and tell people, oh, the economy is doing great, so we're sending you a stimulus check?
I think so. I don't think I'm not expecting a stimulus check. I think if they were to pass this, basically that the closest you get is that child tax credit, which in some ways kind of has a similar impact of a stimulus check, but it's kind of a different, different branding associated with it, and essentially that they're kind of branding that as more of like the long-term structural inequality or social infrastructure, we can call it, sort of thing. So agree with it or disagree with it, it's essentially a different timeline and a different branding point. They kind of view that as more investment rather than emergency action. So that's how they can essentially sell that idea, even if you have say low official unemployment. In addition, the Fed's still acknowledging that even though the labor market got tighter, that there's still kind of inequality out there, in the sense that you see, for example, unemployment went down and jobless claims went down, but labor participation is still very low in the U.S. in many places. But so, for example, Japan has a median age that is 10 years older than the United States, and they currently have a slightly higher labor participation rate than the United States. And that's not been the case for a long time, but it started to be in 2020, and it's been persistent for now, call it a year and a half, where they've had a higher labor participation. So we clearly have an issue there. I would say a lot of it's tied to these ongoing, the petrodollar system, how we've kind of outsourced our supply chains, how some of the fiscal policies we've done over that made us less competitive. There are a variety of reasons for that. But essentially our weak industrial base, I think, plays a role into why our labor participation is weaker than we'd expect given our demographics. And so the Fed's aware of that while also trying to fight inflation. So that's where you get that risk of a stagflationary scenario, where you have, in some ways, a tight labor market due to skill mismatch and due to all sorts of issues, while you still have a lot of people that would prefer to be employed but just can't be.
All right, well, lots of different ways we could go with that. And I want to get to the specific investment questions or commodities that I know the audience wants to hear about. But before we go on from the macro, I just got to ask, you mentioned the populism, and I was really quite impressed with your article on the addressing whether the QE creates more wealth inequality and the implications of that. So I won't hold your feet to the fire for some big prediction about the future, but if you could just describe for us your outlook on the future. Are you expecting? I mean, I find these things very unsettling. I find I mean, there's always been a cultural and political divide in the country, or more than one, but it seems more virulent to me lately. I mean, the hatred of the red and blue sides, I've never seen anything like it. I mean, I was just a kid during the Watts riots, so maybe it was like that back then. I don't know. But in my lifetime, this kind of just entrenched, if you're not, with us, you're against us. It's friends and enemies. It's not just, there's no different stripes. There's no rainbow out there. It's black and white in so many lines, and that scares me. How do you see not just the economy but our society going forward? Are you an optimist, pessimist, or what do you think?
I think I'm probably a pessimist in the intermediate term, and I think it depends how we handle those challenges, whether or not we can be optimistic longer term. So if you, a lot of people are familiar with the concept of the fourth turning. So it's a book published by Neil Howe and his co-author in the 90s. And if you read it, it's eerie how accurate it ended up being. And the concept there is essentially that society goes through generations, essentially a 4-generation cycle, where institutions are built, and then they kind of slowly unravel for a few generations until there's some sort of massive event that kind of reshuffles everything, and your society falls apart. But then there's some kind of new consensus that forms, new institutions are built, and you kind of start that cycle all over again. And it's one of those things. It's been criticized as kind of astrology for intellectuals, right? So it's got this cycles and all that kind of thing. But for me, what makes it interesting is if you look at, the fourth turning is what he coins as the period of where everything gets kind of destroyed, and then in the next one rebuilt. That's kind of the scary of the four cycles, and that's what we're in now, according to his analysis. Now, so what makes that interesting to me is that if I look at the long-term debt cycle, right? So I'm kind of inherently more quantitative person, so I like the fact that people cover the social elements. I cover the social elements too. I look at things like wealth concentration, signs of populism, voter polarization, politician polarization. So, for example, how many bipartisan votes there are as percentage of total votes. So you can quantify polarization and it's not just like we say it feels worse. That's obviously an element as well, but also there are ways to quantify it, and they have gotten far more polarized. But so from my perspective, if you look at the long-term debt cycle, which is essentially the issue when you run into debts that are so high, they're essentially unpayable, and that they end up having to, in some way, reset the monetary system in order to pay it. Whether it's financial repression, holding rates below the inflation rate for a long period of time, whether it's something like a gold devaluation, those types of events, they happen during fourth turnings, right? So it's like in some ways Neil Howe covered the social aspect of what's going on, whereas I like to look at the quantitative stuff under the hood in those cycles, and they line up quite well. And in addition, when you look at how the monetary system's structured, you generally don't get too many decades before that system runs into entropy. Basically, it has faults in its own design, and it slowly starts to kind of unravel, and then eventually kind of hits a breaking point. And so, you had the gold standard. The issue there was that it got centralized. So the gold was held in centralized vaults, and then banks could they could make new currency by issuing loans. You also had the offshore, the Eurodollar market able to multiply currency. And so you had that decoupling between the amount of currency and the amount of gold backing it up. So that eventually broke, in addition to wars, obviously. So, you go to the Bretton Woods system, you had the same issue. Basically, the entropy in that system was that the United States was drawing down its gold reserves to maintain that system. It was unsustainable because you had no real linkage between the gold and the ability of banks to keep creating new currency. And so eventually you had that disconnect. And then you have the petrodollar system, which ever since the 70s. And the downside of that is that the United States keeps drawing down its industrial base in order to run these persistent trade deficits in order to get dollars out into the system. And so each one of these has kind of a fuse on it. And as that draws down, you start getting more and more problems. So when you look at the kind of the social cycle of the fourth turning and the generations, which obviously has some, it's a very qualitative type of analysis, but it's historically interesting. And then you combine that with the quantitative aspects. I do think that we're in the middle of a couple decades of turmoil. And I think how we handle that turmoil sets the stage for, whether or not we have a whole kind of rebirth ahead of that, right? So we have demographics issues, we have polarization issues, you have changing power structures in terms of the United States' role in the world, different trade-offs that people make, a massive distrust of public and corporate institutions, right? So people, their trust in presidents and Congress and media and organizations like that is a near an all-time low, or at least a modern low. And I think basically that a lot of these institutions are not really going to make it in their current form looking out 20 years. And it's one of those things where it's a decision point. So if we handle it well, like the prior fourth turning would be the 30s and 40s. And some countries handled that far worse than others. Some countries got through it. They had a really difficult time, but then they had flourishing after that. And so it really is going to depend on how we handle it.
So the Lyn Alden forecast is not for one particular outcome or the other, but just for big change.
Yeah, massive change that's unpleasant. And that basically people have to handle it as best they can and kind of, try to stay productive until we get through this period and hopefully then have a dawn rather than just a more depressing period after that.
And at the same time, we also have technology reshuffling things, and without necessarily conscious direction. I mean, the internet and social media have changed so much. and it just sort of happened. No, it wasn't something somebody planned. Oh, let's build this and it will have this result. It just happened. And you've got one guy who's made rockets reusable, through his vision, and who knows if we come, so all kinds of things shaking up the long rabbit hole there. We don't need to go down. Let's talk about some of our metals and areas of common interest. I was really stricken by the way the initial response to the FOMC announcement was, bearish for gold. The stocks took off, and I was kind of curious because we got what was expected, I guess, but it is a hawkish turn, so it seemed risk on in the face of hawkishness. What do you make of that? I have a theory, but I want to hear what you have to say.
I'm curious to hear your theory. The way I interpret it is that a lot of it is based on how hawkish it is compared to expectations. So markets have been in some ways pricing this in for a while. They got a little spooked when, whenever there's a surprise, like when Powell talked about acceleration of taper a little while ago, that spooked markets to some extent. And so if anything, this one came in about as expected. So you got the acceleration of taper that was well telegraphed. Their forecast of rate hikes came in a little bit on the hawkish side, but on the other hand, Powell was asked, if inflation is this hot, why are you still buying assets? Like why taper it? Why not just stop? And he basically said that because they have to maintain financial stability, they want to move very slowly on it and be cautious and make sure there's no issues that happen in the markets. And that kind of shows that they're still committed to fighting these instabilities that pop up, whether it's the credit markets, whether it's repo, whether it could be equities if they get bad enough. There are things that would trigger them to kind of reverse, and so they're not really kind of on tone deaf autopilot with tightening.
Right.
They're tightening with the caveat being that if something breaks, they're going to reassess. And I think the market was somewhat reassured by that.
And he did say that. He was asked about that too, and he said, I can't quote him exactly, but basically the rate hikes are assuming a certain amount of growth. So if the growth isn't there, the rate hikes won't be there. So I think that's part of it. But there was also the dot plot, because I think things started to shift before that he got to that part of the Q&A. And if you look at the dot plot, it's striking how all 18 dots are now, liftoff. They're all looking at some, there's only one that saw only one point above, and all 18 are, yes, we're gonna raise rates in 2022. So that was striking, but well telegraphed in advance. But then you look after it, it flattens. By 2024, they're looking at maybe 2.5% in an environment of 6% inflation. So that, I think, looked more dovish than people were expecting. Like if they were expecting takeoff, maybe they expected it to keep lifting off, but instead it flattens. So at the same time, then you get the press conference and you get Powell saying, this isn't the inflation we wanted, this isn't the inflation we expected, it's going to last longer, and oh, by the way, the rate hikes are not written in stone. So now you've got high inflation and, a little more wishy-washy. So it looks super hawkish, right? We're going to double the taper, we're going to raise rates 3 or 4 times next year, and yet market goes risk on. It's kind of reversing a bit today, but gold's actually responding even better today. So interesting times. Why don't we segue there, not to put words in your mouth, your outlook, without a crystal ball statement here, your outlook on monetary metals, gold and silver. How are you feeling? What are you buying? Are you interested still or looking for the exits?
I'm kind of holding the allocation that I have been. And so I've had a couple of small pivots. So I was bullish from late 2018 up into mid 2020. In my August 2020 newsletter, when we started to see kind of real rates, the way they measure with the tips market, kind of hitting a local bottom, especially because there's a lot of euphoria and positive sentiment in that space. I was expecting a consolidation, and kind of my bullishness shifted for a period of time to Bitcoin, through 2021. Now,
sorry, Lyn. Let me jump in and ask. Did you get hate mail for that?
Not really, no, because I didn't. It's not like I said everybody sell your gold, buy Bitcoin. I was basically saying, okay, we've had a lot of price movement in gold, and here's why. So as long as I explain my reasoning, people follow on board. Now, I would say with the whole Bitcoin thing, it's separate. Is that I've gotten a lot of people that love that research, and a lot of people that don't like that research. but not that specific gold to Bitcoin pivot. There's not a lot
I
of
was I was
contain on
asking
a lot of
about that
that.
because I did a Kitco interview in at the same time in August of 2020, and I was saying, $2,000, there's not a crime to take some profits. And boy, did I get pushback. People are like, oh, you're giving up too early. It's going straight to 3,000 or 5,000 or XYZ guru says 10,000 or whatever. What do you mean sell? I didn't say sell. I said, it's not not a bad time to take a little profits. If you got big wins, don't let them slip through your fingers. So much pushback from the gold bugs on that. So just wondering. I guess we know your audience loves you, and that shows it.
And it's it is so far I guess it's lasted longer than I would have guessed. And so for example, I was expecting maybe a 6 or 12 month consolidation, and so far it's gone longer than I would have guessed. And so and back in, I think it was March of 2021, we started to see some signs that it might be bottoming out and turning back up, and we saw kind of a bullish April, but then we kind of rolled back over. And so from that point, it's been a little bit weaker than I would have guessed. And I started to basically link that to essentially that I think in many cases Bitcoin and crypto got big enough in 2021, and a lot of the excitement was there, that you had some of a evidence of inverse correlation of fund flows, right? So that basically that some of the money that it would have otherwise stayed or gone into gold and silver went into things like Bitcoin, went into some of the other cryptos, and so I think now they're kind of in a period of competing for market share. So one of the potential bullish catalysts for gold and silver is if you have an ongoing consolidation or correction in crypto, then you can get kind of a re-lift off in gold and silver. So I would say essentially kind of like how when people analyze gold markets, they have to look at things like real rates. They have to look at things like how strong the dollar is. None of those things can for sure affect the price of gold, but they're all variables. And now I think another variable that people have to consider is what is Bitcoin doing? What is the broader crypto space doing? Because that's kind of this competing alternative money type of asset. And so if Bitcoin is absolutely going parabolic, that puts, all else being equal, some pressure on gold. Whereas if those are having a correction or consolidation, it basically gives gold more headway to keep accruing value. So overall, I'm
Let me
kind of
jump in. I
neutral.
was gonna get to
Yeah.
Bitcoin a bit later, but since you brought it up and connected the two, I certainly get that momentum chasing capital will go after whatever's hot, and if it's Bitcoin, not gold, or vice versa. But there's also, talk about social divides. There's a lot of animosity here too, but let's set that aside and just sort of intellectually, there's there's a commitment here on some of the people in the crypto crowd, if not most of them, that this is the new gold or the new form of money, or this is the future and gold is the past. Can you see that sort of person saying, oh, cryptos are going into reverse, I'm going to reallocate to gold? Or really vice versa?
So I think probably not those people that are sure, right? So if someone's adamant, people that are say all in on Bitcoin, if Bitcoin goes down, even if it gets cut in half, they just buy more. I think the general, we've seen generally institutions have even said that they some of them got into Bitcoin that might have otherwise had a position in gold. I think those are the types of more flexible capital that are kind of willing to shift based on what's happening. Same thing with kind of sophisticated retail that is not fully committed to one or the other. They want to see, they want to know what's going to do well. And so I think there are pools of capital that are willing to rotate around. Whereas the other ones, there are people that own gold that will never ever want to buy Bitcoin. There are people that own Bitcoin that never want to own gold. I think those two camps are hard to change. Right? I think there's a lot of capital in the middle that is willing to hold both, or that is willing to shift back and forth and try to actively trade it. There's obviously lots of different market participants out there.
Alrighty. So, bottom line, Lyn Alden outlook on gold. You still see this as a correction? 2020 wasn't the top and it's downhill from here? Or what's your outlook going forward for gold?
So my overall base case is I still think it grinds higher over the longer term. It could be challenging to do in a tightening environment, but if stocks start doing poorly, then gold looks attractive in relative terms. Also, in an inflationary environment, stocks can face margin pressures. So if their expenses rise faster than their ability to raise prices for their business, they could run into margin pressures. And we've actually seen evidence that margins may have peaked in the recent quarter, and that they're kind of now on a sideways to downtrend. In addition, if you look at certain types of equities, you have maybe antitrust regulation issues that they could face. You have other sorts of things that can go after them. So they have a variety of risks, whereas a monetary metal that doesn't have a profit margin and it, just enjoys negative real rates and expansion of the money supply, while it itself is, a very slow inflation just from mining activities. It's measurable, it's low. That's a more attractive in that type of environment. And so overall, I think it's still an interesting, asset to hold as part of a diversified portfolio, especially for people that don't have a super high conviction on any one stock sector or super high conviction on Bitcoin. People have different kind of probability assessments for how they see things working out. We also see, for example, governments are still firmly in the gold camp, right? So, you have El Salvador with Bitcoin, but besides that, most countries are still holding gold. Bitcoin is not a big enough market really for them at the moment. Many of them are still buying gold actively, and so that's still kind of the foundation for a lot of their foreign exchange reserves.
I think that's particularly interesting. Look what we do, not what we say. Do you include silver still as a monetary metal, or are you in the camp that sees it becoming an industrial metal, or how do you see silver? Same as gold or any different?
So I view it as a hybrid in the sense that it still has monetary properties. If you look over the very long term, I think you're one of the ones that have been critical of the gold to silver ratio, if I'm not mistaken. And one way I interpret that is essentially if you look over the very long term, gold and silver generally were in like a band of, say, gold was 10 to 20 times more valuable than silver on multiple continents for long periods of time. In modern history, it was often close to the middle of that, around the 15 to 16 range. And one of the arguments I've seen that I think is compelling is essentially when you had modern banking. So you had paper currency tied to gold, and then you also had telecommunications channels, so you could send money around the world between banks. Starting 150 years ago, right, with the invention of the telephone and those types of technologies, you essentially improved gold. The one downside gold always had relative to silver was that even though it was a harder metal, it was less divisible, right? Because even a small gold coin was a lot of money, whereas silver was more of the every person's money. And so that's why you had a lot of bimetallic standards throughout history, even though they have their own challenges. Whereas when you could make gold more divisible, and you could send it around the world, it arguably took away some of silver's appeal relative to gold. One of its major advantages over gold went away. And so ever since then, we've actually seen kind of this more persistent decoupling where silver is trading at a lower multiple relative to gold. And so I would say it's been in some cases, demonetized at a more thorough pace than gold. To some extent, they've both been demonetized in the official sense, right? So we don't back our currencies with them, whereas gold is the one that's still held in central bank vaults. It's a tier one asset, and so that has retained more of its monetary premium, I would say, than silver. Now, in an outright inflationary environment, especially for retail investors that you can only maybe buy one or two gold coins. Silver is a much more appealing situation. It's also useful for, if you were to have kind of a major event, it's more useful maybe for exchanging in those denominations. And it also has that huge industrial usage, especially in an electrification economy. So as we get more and more technology, it's very useful. So I view it most as a hybrid metal. Well, it still has monetary premium. There are still investors that buy it purely for monetary usage. It's still minted into coins, right? So it still has more of a monetary premium than just about any other commodity, save gold. But that I think it's been somewhat demonetized relative to gold in the structural sense.
All right. So the bottom line question is, though, does its price track with gold? If gold breaks out again, does silver go with it, or does it get left behind?
I think their directions are more likely to be similar, right? So I would find it unlikely to have a huge gold breakout while silver doesn't follow.
Okay. All right. So industrial metals. We can take that with or without the electrification story. Presumably, as a person calling for inflation, you're looking for higher commodities prices in general, metals prices in general. Is that right or wrong? And are there any particular favorites you have in that space?
So I think copper and nickel are both very attractive over the long run. I've been more cautious on copper in the intermediate term, because it went very far very fast, and then you have this tightening cycle. And so I don't have a strong view on copper in, say, the next 12 months or even 18 months, right? I think that's, I would leave that to people that follow that market more closely. If you look at the long arc of where things are going over the course of this decade, with not just electric vehicles but also electrical grid updates, to accommodate that sort of thing, I do think that you're going to see a lot of copper demand, and that if there's supply is still tight if you look at that level of demand at least, and so I'm long term bullish on copper, whereas in the intermediate term I'm more mixed on it. Same thing with nickel as well. I think a lot of that's going to trade based on macro things more so than specific supply and demand over say that type of period. There's also things like China cooling down its property sector can affect copper, can affect iron, things like that. So that there's these macro events that can influence it. The one market that I'm following a little bit more closely than those is energy markets. I've kind of ramped up my coverage of energy markets over the past couple of years, and it was kind of just in time for the whole energy crisis in Europe and China. I wrote about that in mid 2020 in the summer, talking about that I think that oil and gas is going to be more scarce than people think, and that some of those equities or some of those commodities are likely to do pretty well. I didn't really expect late 2021 to have as big of an issue as it did. So it was admittedly more accelerated than I would have guessed. But the types of problems we're seeing in Europe are actually the type of thing I was expecting maybe to happen in 2023 or something like that. So it's all been compressed. But I'm still generally structurally bullish on some of the higher quality energy producers, and also transporters.
And how does uranium fit into that, or does it?
So again, it's kind of like copper. So I'm long-term bullish on uranium. When we had kind of that euphoria, so Sprott was buying a ton. They were kind of cycling that up. Some people were putting kind of like yellow laser eyes on Twitter onto their profiles. Once we started to see Sprott's premium kind of fluctuate and have these periods of going negative, that can take some of that buying out of the market, right? So it kind of that supply squeeze can temporarily halt. I watched this happen with the Grayscale Bitcoin Trust earlier this year, and that had a big impact on Bitcoin's price. So when I saw Sprott's premium go negative, I wasn't like, okay, sell your uranium now, but I was like, I'm now more mixed on uranium in the intermediate term, because we have come up pretty far pretty fast, and some of the catalysts now, the biggest buyer might be buying more slowly. And so I'm still structurally bullish on the nuclear industry. And I think probably uranium still has a lot higher to go in the longer run. But in the intermediate term, I'm primarily using it as a portfolio diversifier rather than having a strong directional view on what it does over a 12-month period. So I kind of put that into my too hard bucket for the moment, and just kind of use that as a diversifier.
All right. Relating then still on energy, do you have a horse in the green race? Do you think that it's going to be EVs forever all the way, or is hydrogen fuel cell technology going to come along and eat the EV lunch? It, I'm, and let's set aside whether or not politicians should be pushing the world to get rid of internal combustion engines. That's happening. Let's just take that as a given, or at least I think that it's a given. That's popular. It's not going away. That's how they get votes. But it doesn't have to be lithium ion batteries. What do you have a thought on that?
So I think it's going to probably depend on certain material science breakthroughs that are hard to predict, right, for both batteries and for hydrogen cells, right? There's a bunch of different ways to do it. It's also one of those things where I think people extrapolate too much, and so electric vehicles have certain advantages and disadvantages, especially for example in cities where you have a smog problem, right? So basically, it's an acute urban air quality situation, especially when you look at emerging market cities. But really, the combination of coal production and the automobiles in the cities, often with less regulations about their emissions, right? That can cause acute issues. And so especially in cities, electric vehicles, and also hydrogen cell vehicles, if they continue to advance those, are attractive. Whereas if you're in a suburban or rural environment, that's arguably less attractive than in that city environment. In addition, I kind of look at some of the bottlenecks in terms of materials, going back to the commodity question, where I think people like underestimate how much materials would be required to change out the entire global fleet of automobiles to being electric. And in addition, the problem there is that they want to go green, but electricity is not an energy source. It's just an energy transmission way of transmitting energy. And so right now, if you look at global energy consumption, something like 3% of it is wind and solar. And the other 97% is everything else, mostly fossil fuels, some biomass, some hydro, some nuclear. They're the big ones. And then around the margins, you have these other little things, and you have wind and solar. And so if you have an electric vehicle and then you plug it into a grid that's coal, right, like India or China, you're not exactly doing a lot there. And one of the challenges with wind and solar, obviously, I think basically electric vehicles and wind and solar are going to grow as a percentage of their respective industries. But there's kind of a limiting point to how high they can get. You can't just extrapolate that to say they're going to eat everything. Because if you look at wind and solar, for example, they have intermittency issues. And one of the ways to solve that is with storage, but then that requires more of those types of, you know, battery metals, right? So you're again into that commodity issue. I think people underestimate how much material you would need in order to have grid level storage everywhere for these intermittent power sources. So overall, I think that we're going to see different technologies compete. I don't have a strong opinion on where that shakes out, but I do. One thing I've used pretty strongly is that I think people are overestimating the speed and the completeness for how rapidly these technologies can replace internal combustion engines and fossil fuels in general. So I'm taking the under in terms of the proliferation of those technologies, the speed and the magnitude with which they do it.
Yeah. Meanwhile, the bans are spreading, and the stop now OECD movement, if you will, is spreading. I'm I don't have a time on this. It's hard to predict, but I can very easily foresee a world in the not too distant future where the green agenda actually makes oil companies some of the most profitable in the world because production's been cut, it's still needed, the prices go way up. It could the green agenda could be fantastic for oil and gas speculators.
This is something I covered that in my 2020 article, and I actually just put out a newsletter that touched on the subject. So I fully agree. I think you have to be careful about jurisdictional risk, right? So if they start to do very, very well, governments could go after them for that. So you might want to spread out your jurisdictional risk. So by having oil companies, gas companies in different countries, so they have different regulatory risks. But essentially, I do view the combination of there's so much investment in those other sectors, then there's limitations, lack of money wants to go into oil and gas. And so one thing, if you look at, is that they've become far more self-sufficient in recent years. So if you look at shale, for example, it was unprofitable in general. It was very reliant on issuing new equity, new debt, and getting a lot of that perpetual funding to keep drilling. But now that that's dried up, so one, investors got tired of lighting their money on fire. They just got tired of poor returns, even aside from ESG issues. But then when you also add kind of these more qualitative decisions to just divest from oil and gas, regardless of the returns, it means that those companies have to be more self-sufficient. So they want to do things like strengthen their balance sheet, drill less, return more capital to shareholders, basically, fund their operations out of free cash flow rather than rely on external shareholders. And so I do think that that's a pretty attractive space to be in for investors in that over the next, say, 10 years. Now, in any given 6 to 12-month period, you can have OPEC plus decisions, you can have virus variants, you can have accelerating or decelerating economic growth that can affect the valuations on those cash flows. But I think over the long run, it's going to grind out most likely, and a lot of the returns are going to be from dividends, buybacks, special dividends, balance sheet improvements, things like that, as the industry is kind of this more self-contained. And the analogy that I've used is, and I've seen others use as well, is the tobacco industry, where cigarette smoking was slowing down in the 90s. So people said, okay, it's a terrible investment now, it's not going to make any money, and then ironically, that industry outperformed the S&P 500 since that time. And it was because one, they were blocked from advertising, so you couldn't really get new entrants, and the existing people, they could just not spend on advertising and just put that all towards dividends and buybacks and things like that. They were trading at very low valuations, so dividends and buybacks that were reinvested went a lot further, and they were still able to raise pricing. And so that was an example where there's not a lot of interest in that sector, and it just slowly, quietly, with no fanfare, went to outperform. And I think you could have that kind of situation with energy. Or you could have a more spectacular case. If you have ongoing acute energy shortages, then you can get a more obvious period of outperformance, or you can just have that long dividend focused kind of grind to higher returns. And if you look at the S&P 500, the energy sector hit its lowest ever percentage of the S&P 500 in 2020. It went down to 2% of the market cap, and it's since bounced, but it's still only like 3%, and that's still well below the average. And I think it's going to trend up over time. And then especially if you consider the fact that the S&P that the energy sector has higher dividend yields than the broader S&P 500, means that even if it just kind of stays at roughly the same percentage, you're getting a much higher yield over time. So you're benefiting from that valuation increase, you're benefiting from that grind up, and then you're benefiting from all that capital return as well.
This is classic interaction. I have an idea based on sort of my fundamental view. I ask you about it, and you've got examples and prices and numbers and historical data to bring to bear. I love it. Okay, we've been going at this for almost an hour here, Lyn. I very much appreciate your time. I don't want to take too much of it, but I did want to touch on one more thing, or maybe two, before we go. One was back to Bitcoin. When you and I spoke last, recorded our previous interview, Bitcoin was around 40, and I said, put your feet in the fire, yes or no. Is Bitcoin a good buy here, yes or no? And you said yes. And of course, since then, it went up to the high 60s, almost 70. Now we're back in the 40s again. Rather than any kind of price forecast or whatever, I have a very specific question. And maybe you're not the best one, because I don't think you're a Bitcoin maximalist. But I understand that there's only ever going to be 21 million whatever Bitcoins. And that's scarcity. And frankly, people criticize it as artificial scarcity. I don't care if it's artificial or natural. It's still scarcity. There's only ever going to be 21 million of them. So on its face, if they have any value at all, and you got billions and billions of people, and there's only ever going to be 20, I get that. That is scarcity, artificial or not, it's there. But then you have the proliferation of other coins, and they can all do what Bitcoin does, at least theoretically. So my question is, can you help me understand why Bitcoin should have any value at all? It isn't. It's an electronic ghost. Its functions can all be replicated. Since it's not physical, it can't be used like gold to even make jewelry. If you make that as a minimum use case for gold, you can make jewelry out of it. You can't wear a Bitcoin. You can wear a Bitcoin holder, but not the Bitcoin itself. It's scarce, but it almost doesn't exist, is the way I see it. Can you help me get over that hump? Why does that scarcity matter in a world where everybody can create other coins that do everything just as well or better? Help me out.
It's a really good question, and that was my biggest hang up, because I covered it in 2017 and passed on it partially for that reason, also because you had a lot of price run up at that time. And so I covered it when it was like 6,000 or 7,000 in late 2017, explained why it was interesting, and then passed on it. And one of the reasons was that. And it had a blow off top, then it crashed, and then it consolidated for a couple of years. And ironically, I bought it at the same price 2.5 years later in April 2020, when I viewed as a lot of my risks were addressed. You had a consolidation instead of a euphoric parabola, and some of the...
Sorry, then before you answer, I got to ask, so you got a 10-bagger recently on that. Did you take any profits?
So on some things, right? So my core holding, no, I did not. On, say, for example, I use GBTC for some of my more liquid exposure, and I did dial that back. I took out the cost basis and a little bit more than the cost basis when that went up significantly. And so that model portfolio, for example, which is a real money portfolio, that one has de-risked that exposure to some extent.
Awesome. Congratulations for that. Sorry for interrupting. I was just curious, but yes, please help me out.
Yeah. So the way that I think about it is this. So basically, if you look at technologies, you have network effects, right? So there's nothing stopping another Facebook from popping up. I could make a clone of Facebook. And the question is, can I get critical mass of people there so that it's actually a useful network compared to the real Facebook? Same thing with Twitter, same thing with these other things. And so, especially in cryptocurrencies, security is tied to adoption. And so, for example, Bitcoin has the highest hash rate among cryptocurrencies, meaning that, if you were to try to do a 51% attack, if you wanted to, do a double spend attack, you need to buy billions and billions of dollars of equipment in a world of semiconductor shortages, get that equipment, and then channel enough electricity to power Singapore into that equipment, and that's what it would take to attack the Bitcoin network with a double spend attack, right? Whereas if 1% of Bitcoin miners want to attack Bitcoin Cash or Bitcoin Satoshi Vision, they can do it. They can just do a 51% attack if 1% of them are bored that day, because they use the same hashing algorithm, but they have a very small percentage of the network effect, right? The overall hash rate. So basically, Bitcoin is the one that is the most secure in terms of the adoption, the security, and the reach that it has, right? So that's not bulletproof. So I monitor risks and competitors to that network effect. And so if you look at how Bitcoin compares to other cryptocurrencies that try to be money as their main thing, so Bitcoin Cash, Bitcoin Satoshi Vision, Litecoin, Dogecoin, all these kind of, their main thing is their money. They all have a tiny, tiny percentage of Bitcoin's market capitalization, single digit, sometimes a fraction of a single digit percentage of Bitcoin's market cap. And so Bitcoin really kind of won the race in terms of being money. Now, the biggest competition we're seeing now is from the smart contract space. So things like Ethereum, Solana, these other protocols that attempt to do more than just be money. They want to be smart contracts. They want to be decentralized exchanges. They want to do NFTs. They want to do DAOs, like decentralized organizations. And those are all interesting technologies. The issue there is that in order to have that extra complexity on the base layer, they sacrifice some degree of decentralization. So they have these more centralized attack surfaces, so that they're less like quote unquote cypherpunk than Bitcoin, whereas Bitcoin's more like a Tor, whereas they're more like Napster. They have basically these centralized things that can get their heads cut off if governments really go after them. And I do think we're going to see more regulation, because a lot of them they pass the Howey test. So if people that are not familiar, the Howey test it's basically a test to determine whether or not something is a security. And so if you raise capital and then you use that capital to make your system better with the goal of improving its price, you're essentially a security. And so Bitcoin did not raise capital, right? The open source software was put out there. People could run it. People could mine it. There was no ICO. They didn't raise capital and do anything like that. There was no promises to make it better. And so Bitcoin and a few of its hard forks are basically classified as commodities. They don't pass the Howey test. They're not securities. Whereas most of the smart contracts and many of the other ones out there, they pass the Howey test. And so they've kind of been in this regulatory gray zone. Some of them have been sued, but really so far it's unclear how some of them are going to shake out. And we see that the SEC and other areas are kind of more focusing on that now that it's grown so much in 2021. It's more on their radar, and combine that with their regulatory tax services. It's not really money in the same way that say Bitcoin is attempting to be. It's just kind of this. I'd view them more like equities. So it's kind of like Tesla stock compared to gold in that sense. So I do view it as especially a near-term concern. It's kind of funny. Bitcoin bull markets kind of kill themselves, because when Bitcoin does well, people make 1,000 new cryptocurrencies and they speculate on those, and eventually you exhaust new buyers because you have this inflation from these other altcoins. Now, generally, what happens at the end of that cycle, 99% of those altcoins get permanently killed, right? They just go down, 90-some% and stay there forever. They don't participate in the next cycle. And Bitcoin's the one that keeps sticking around. You've had a couple of others that have been able to stick around as well. And so I think over the long arc of time, the network effect of Bitcoin, as well as the specific way it's designed, so it optimizes decentralization and its monetary properties above all else, are what is making it, the most secure, the most useful. And so it's unique in that sense. It's hard to replicate the path dependence that Bitcoin went through. But it's by no means assured. So I do think that people have to monitor that risk, that altcoin inflation risk, to see how it impacts Bitcoin over time. So I always view it as an intermediate risk, right? So in any given cycle, generally those other coins do better in the bull phase of the cycle. And I think the big question is whether or not there's going to be one that rivals Bitcoin in terms of its monetary properties. And at the current time, I don't really see anything on the radar that comes close to that.
All righty. Well, I guess so. Just on the bottom line guidance, if you are new to the space, like you completely poo-pooed cryptos now, and you're kind of thinking, well, maybe I should at least put some play money in there, would you buy now, or would you wait to see the regulatory response that's sort of heating up in the US and other places, and then see if that creates a buying opportunity? Or what would you advise people new to this space who are thinking about it for the first time?
So I think it's useful to learn about it at least, so that they can make their own decision. But then I would say essentially, so I view dollar cost averaging as useful. So there are services out there that let you dollar cost average in over time, and then basically someone can set up a small little thing, so they're not tied to any one entry point. If they do want to look at entry points, so wait, right now what I'm watching is I do view most of the indicators as looking fairly bullish on Bitcoin over say the next year or two. It's not assured, but for example, if you look at on-chain dynamics, so if there's because Bitcoin's an open protocol, you can see what different types of entities are doing, even though you can't necessarily link those entities to a person, right? So you can see what's happening with coins that have not moved in over a year. Are they moving now or no? Are most of the changes happening in the short end, right? So people that bought, 3 months ago, are they buying and selling now? So you can kind of do analysis like that. And generally what we're seeing is that we're in a consolidation where coins are kind of flowing back to those stronger hands. Whereas in bull markets, those stronger hands tend to, distribute into strength and new buyers come in. And so I view kind of us as coiling right now. One thing I've cautioned my clients on is that we don't really have a clear bottom in place. Like there's no kind of strong evidence that a bottom's in place. Now we absolutely could have a bottom in place for this correction. I don't know, but it's kind of guessing at this point. So I would say if someone's interested, they probably should learn. They can start to see if maybe you start to get a bottoming process either from these on-chain indicators or from just basic technical analysis. Look for kind of a higher high rather than these grinding lower lows. And then I do think having a non-zero position is useful, but people should only dial it up to what they're comfortable with.
Non-zero position. Well said. All right, I gotta let you go, but before I do that, I just wanted to mention, I don't know how I missed it before, but there is a Lyn Alden book on your website. There's a link to something called the Stock Delver, and I didn't have time to look into it much. Can you briefly tell us, is it the world according to Lyn Alden, or is it just nuts and bolts Stock Delver? Here's the tool. What's in your book, Lyn?
So yeah, this is very kind of nuts and bolts. It's a short digital book, and it focuses essentially on stock analysis. So how to kind of what to look for qualitatively and quantitatively in an investment that is intended to be held for 5 or 10 years or more.
So,
So it's not
so
a
this is the
trading.
Lyn Alden version of Graham and Dodd?
Pretty much, yeah, the lighter version. And one thing I wanted to make use of the fact that it's digitally native, so it comes with an Excel sheet to apply some of the valuation. And actually have one of Graham's valuation methods in that Excel sheet, as well as some other valuation methods that I use. And so there's a variety of different tools there that investors can use to value a stock based on their forward cash flow assumptions for that stock, and basically use their own discount rate, how to determine what a fair discount rate is in order to come up with a fair value. And so it kind of covers some of the qualitative and quantitative aspects for how they might go about that. And so it's something I wrote a few years ago. It continues to be popular, and it's kind of an evergreen product.
That actually reminds me of the very first question I asked you. If we're in uncharted waters. I mean, we've been in uncharted waters since 2008, but even more so since the COVID smashdowns and all the crazy things governments have done. Do any models make sense anymore? Is any model safe to use these days in uncharted waters?
So certainly not in the short term. And so we 2020 was almost a year where it was inverse to everything you'd expect, right? So if a company
Negative oil
doesn't
prices.
exactly negative oil prices, if a company doesn't make profit, even better. If it doesn't make revenue, better still, right? Just soaring. Now in late 2021, we've seen the air let out a lot of those memes, right? So I mean, there's real companies there, but that just got really overvalued, right? That are kind of early stage, not profitable yet, but there's actually real products there. And then you had actual memes that are just kind of everybody knows that they're like tenfold overvalued. And it's just it's if anything, it's part of that populist movement we talked about, basically sticking it to the man. And so you've seen some of the air come out of those. So in the near term, valuations and fundamental analysis don't really tell you anything about what a stock's going to do in 12 months. In extreme cases, it might not tell you what it's going to do in 3 years, but it should tell you quite a bit about what it's going to do over 5 or 10 years. And then especially if there's a way to fundamentally reward you over time. And so it actually works even better for dividend stocks and things like that, because you're less reliant on the market realizing that you're right. kind of like those tobacco stocks, right? So if you bought tobacco stocks in the 90s based on fundamentals, you never really had the market never really had to agree with you. You just got paid over time with dividends and buybacks, and just kind of kept growing that. And so even they never really had to get revalued at a higher level. Whereas if you have a company that does not pay dividends, you're only based on price. Eventually, the idea is that either they're going to get so big and mature that they're going to start paying dividends, or that eventually the market will, find it impossible to ignore your bullish thesis, and eventually they will realize that and catch on. And so, how long that takes depends on the type of company, whether or not they return capital to shareholders.
And in the case of my pesky little junior mining stocks, there's also the third out, which is the takeover. When,
Exactly. Yep.
those are things of beauty. All right. Well, thank you
Good
so
point.
much for your time, Lyn. It's always fascinating to talk to you. Always insightful. I'm going to have to go away and think about some of the things you said. Very much appreciate it. Last word to you. Any final things that you want to make sure our audience thinks about today, the day after the Fed decision?
Yes, I would say the next few months, even though we're tightening rate of change terms, we still have the major central banks, Bank of Japan, ECB, and the Fed are still expanding their balance sheet. And so all else being equal, that is, that's still adding liquidity into the market. But as we look out into, a couple months into 2022, especially the Fed, if they manage to get through their tapering, and they're not expanding their balance sheet anymore, my base case would be a choppier time ahead. Some of these markets that have gone straight up might run into, issues. Uh, Now, partially that depends on, again, if you have fiscal stimulus, you can kind of counteract that for a period of time. But if you get weak fiscal and you have monetary tightness, that my base case would be kind of a choppy period for markets. So I wouldn't be surprised to see some chop. I think you could see good quality things, go on sale, be buying opportunities, and I would just kind of use this period to maybe check everything you own, and to make sure that you're comfortable owning it through a period where we could see more differentiation of quality, like we've been seeing over the past few months.
Time for a gut check. Sounds good, Lyn. All right. Well, thank you. Have a good one, and we'll stay in touch. We'll see how it goes.
Thanks, you too.
Thank you for watching this edition of In the Pit with Lobo Tigre. If you enjoyed or found value in what you just saw, and you're watching this on any sort of social media, please do hit the like button and the share link. Send this on to anybody you think might be interested. That helps us out a lot. If you're watching this on YouTube, please do hit the subscribe button as well. The number of subscribers helps us get more valuable content to you as well. On the subject of subscribing, I'll quickly say that if you're not a subscriber to our free weekly Speculators Digest, I encourage you to sign up. I promise if you do, we will not send you a flood of daily advertisements. You get one free weekly digest with original research not published anywhere else. Check it out at independentspeculator.com. Thank you and have a great day.